to thankful to ASSOCHAM and EGROW Foundation for giving me this privilege and opportunity to deliver welcome address on the topic discussion on marketing policy organized by both ASSOCHAM as well as EGROW Foundation jointly. So I, on behalf of both ASSOCHAM and EGROW Foundation, would like to heartedly welcome Dr. Arvind Varmani, uh, who is former Chief Economic Advisor, Government of India, and chairing of this session today. And as usual, he is always giving his valuable time and to this seminar on after 2 months. Every time we are organizing this seminar, and he is available to us. So thanks and welcome to Dr. Arvind Varmani. I extend my welcome to other panelists, Ms. Upasana Bhardwaj, Chief Economist, Sri Abhijit Barua, Chief Economist and Executive Vice President, SDFC Bank, Dr. Charan Singh, Chief Executive, EGROW Foundation, Sri Indranil Sen Gupta, Head of Research, CLSA India, Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM, and among us, Sri Raman Agrawal ji, whose advice in NBFC is very useful to everyone. So at the end of the session, before end of the session, we would like to listen from him also. So, so these are panelists. So we welcome everyone here, and also the audience who are continuously giving motivation to all the speakers, panelists by their presence. So we also welcome to each and every one of them. So today topic, as I discussed, discussion on monetary policy. As we know, on 4th May 2022, in an emergency meeting, RBI has increased the policy rate by repo rate by 40 paisa, 4.40, considering inflation figure which has increased to 7.1% in March, and other factors. Globally, inflation is increasing due to crude prices and geography, Ukraine-Russia war. So they have to take this urgent call because RBI don't want to increase a big amount in June meeting. So they have done it 40 BPS in the emergency meeting on 4th May 2022. Moreover, if you see domestic economy condition, though our exports have increased to 400 billion US dollar, and in April, May also figures are very encouraging. As well as if we see in domestic front, urban side growth is good, but some weakness in seeing in rural side. But still, uh, uh, urban demand is in double digit, you can say, and whereas that investment activity uh, should be uplifted from robust government expenditure, capital expenditure. So their investment side is good, and moreover liquidity side, 11% increase in credit growth, and liquidity is surplus in the system. Economy, though IMF has reduced its forecast in growth uh, to some extent, and so considering all these, we can think that RBI can and interest rate, because inflation, though it is on supply side, supply constraint, and logistic side remain to be higher because this Ukraine-Russia war and other factors, and recurrence of this COVID time to time. So logistic mismatch is there. So we can expect some increase in interest rate and repo rate, maybe 25 paisa to 40 paisa. So that is my thinking. And I now once again welcome everyone sitting here and all the panelists. Thank you very much.
Thank you. I guess let's start the seminar. As usual, I'll just give a broad overview and then call on our experts who have much detailed analysis and comments. So I want to very quickly, because of the big shock, I can call it policy shock that we had since the last meeting, I want to very quickly review what I call the macroeconomics and pandemic. And really, it's very surprising. I mean, I myself am surprised how on the dot really the research we did in EGROW and which we have built and commented on since then has how true it has been. So I just want to very quickly give you the overview. So the pandemic shocks, lockdowns, and restrictions, we had said that this will result in fragmentation of markets. And what has happened is precisely that, except, of course, that right in the initial papers, we based the analysis on a single wave. But in effect, the different COVID waves in different geographies at different times have really seen very much the same shock. But there is a slight difference, and I'll come to that, between a series of supply demand shocks, which is common, which is the fragmentation of market. So basically, with these shocks, we predicted that there would be fragmentation of markets and there would be supply-demand imbalances in different commodities, in different directions and different geographies. So expect certain excess demand where you would have inflationary pressures and the reverse. Now, that's exactly what we have seen, not just in India, where our initial focus was, but across the world, which we pointed out subsequently in our discussions. But the repeated shocks have the effect that it doesn't give enough time for restoration of normalcy. So there are supply shocks. We expect and still expect, I expect still, that the shocks, if they are followed by a period of normalcy, will actually be temporary effects, whether it's in inflation or other factors. But what has clearly happened, and which had become clear to me by the end of last year, and I will tell you how, was that this has built up inflationary pressures. So clearly, the bulk of the population doesn't have the sophisticated models in their head. And if the predicted temporariness doesn't last, it is kind of natural to build up inflationary expectations, which has happened. So the repeated shocks have, and of course, the latest one of those is something completely unconnected with. There is, of course, the COVID zero policy, which was a shock in itself, and the extremism of it in China. That virtually nothing had been learned from 2 years of experience in every country in the world. And of course, the Russian invasion of Ukraine, which is another shock, which actually is kind of similar to COVID in the sense that, of course, it's primarily a supply shock, but they also demand elements of it. I think less than we had initially said for the big COVID shocks, but that's also true of the smaller COVID shocks which have followed. So the extra thing, of course, is that for India, we were very clear that we needed targeted fiscal and monetary policy in this situation of fragmentation. But of course, across the world, in the US and some other places, we had large stimuluses. And just to take one extreme example, again, the US, I think, though they were beginning to understand this fragmentation, really, if you see the history, which I think my colleagues who are going to speak know it much better, that they actually stepped up the stimulus when the growth and the GDP had virtually caught up. So not only was it untargeted, but it was large and continued to remain large even when the normalization in some sense of that word had occurred in the US economy. So that's an extra pressure. Uh, Firstly, we had said targeted policies, but okay, even if they were not targeted, there was clearly a limit. Even so, beyond normalization, clearly that's a fiscal stimulus which is unjustified if we are looking purely in terms of this supply-demand imbalances, inflation, etc. So by end December, those of you who have a good memory, I am still kind of not 100% sure when I started doing it. I started talking about, I became concerned about the US and started talking about a shift of Indian monetary policy signaling, in a signaling sense, from accommodative to neutral. I think for the last three monetary policy, or perhaps even four, I've been saying that. And uh, and and that was done very consciously, understanding this underlying dynamics of the fact that we would also start getting imported inflation, you know, uh, from the US, for example, which was clearly beginning to overheat, and with the monetary policy late in accommodating. So, of course, this whole thing after the Ukraine war is you had another huge shock, which is very important for India, being that we are probably the largest net oil exporter in the world. The oil shock, in some sense, is added hugely to that, uh, call it imported inflation. So, as a result of which, in some sense, that change that took away the time we had to do this gradually. I mean, so in some sense, what I'm saying is we were justified. I was justified in saying that there should be a change in stance from accommodated to neutral because of all these things which were happening. Of course, we didn't know about the Ukraine nor the severe, extreme COVID zero policy of China at that time in the first time. So what is the implication of this for India? I basically, to me, from this model and what I have said, and I will end with that. Though I normally don't give my kind of recommendations or conclusions on monetary policy at the beginning, but I think it's important to connect it with what I've said. So I really am back, reiterating again that in a broad sense, which I think the RBI has now signaled, it should be clear that we have to move away from the accommodative stance to a neutral one. How it is framed, it's really up to the signaling. The second one is that we have to really, I believe that in this kind of analysis that there'll be no real effects. I still think the inflation will actually come down when the supply shocks expire, okay, until something is done about that or happens on that front. But I do believe that the inflation expectations are building up. For those of you who don't follow this clearly, let me tell you, this is something which has come up on my agenda like for the last 2 decades. You see, a change in oil price will give you an inflation rate which is higher for the whole 1 year. But it is not a continuous inflation. This is something which is critical to understand when we are doing monetary policy. This came up when the oil price shock, which I dealt with as CA. So if you have an increase in oil price from 80 to 120, I'll just take an extreme, you see a massive inflation pass through for one whole year. But we don't call that inflation. Okay, the inflation is over. It's just a pass-through. I mean, from the monetary policy perspective, so you have to decide whether to accommodate that increase or not accommodate it. But is the continuing thing is nothing happening. It's just a simple year-on-year increase which is happening after that. It's a slightly complicated thing, but this is very important to understand. Okay, so if you discount for that, then all you have is how people look at it. If it leads to inflationary expectation, then it is going to lead to further inflation. So, in my view, both RBI and the US Fed should really be thinking of how can they affect inflationary expectations so they don't build up in this process. There is going to be higher inflation. If nothing else changes for a year, the effect of the oil price will be in headline inflation being higher. Similarly, the wheat price increase. But it is not inflationary unless it translates into inflationary expectation. That's a key point I'm making here. So US, the Indian, RBI and the US, they have to focus on what? And as far as I can see, and I'm just giving this as a suggestion because I have not done the recent analysis. So beside the change in accommodative stance, I believe that RBI should target a real repo rate by December or March of between -1 and 0%. Okay. Normally, I would say 0, but because of all this confusion which arises from the kind of analysis I have given, I'm leaving it kind of open and also how much it can affect. So my guess would be that a repo signal is necessary to make sure these inflationary expectations, not the actual inflation. Please, you may not agree with me, but please understand what I'm saying. I don't think this is going to affect anything on the ground as long as these supply shocks persist. But it is important for inflationary expectations. Okay. So these two, and of course, which my other panelists will, from the banks will know much better. Clearly, we will have to watch the credit. As long as the credit growth is low, I don't think there's going to be any problem, real problem, so to say, of excess demand. So my three recommendations on to the RBI: one, change from accommodated to neutral, which in some ways they've already done, but specify it more clearly in the signaling. Two, set a target of real repo rate of between -1 and 0 for December or March. Again, I'm leaving it a little open because I'm not 100% sure. And third, watch the credit growth. As long as that is still low, there's really nothing to worry on the real side in terms of excess demand, aggregate demand. With that, as I said, please feel free to give your own views. There's nothing. Part of the thing we have learned from these 2 years is there's so much uncertainty that certainly judgments can and will differ, and please give your own judgments. So with that, let me turn to our first panelist, and we'll dispense with the introduction because I think everybody knows you. So first, Upasana Bhardwaj, who is the chief economist.
Good evening, everyone. Thank you, Dr. Virmani. So just a couple of things taking on from what you've just discussed. Basically, at this point where we stand, one important aspect is initially, let's go back to pre-Russia-Ukraine issue. RBI was somewhere hesitant to acknowledge the inflationary risks which were brewing up. So that is one thing which we need to recall, because the way everyone in the market was expecting that inflation is going to be much more materially higher than what RBI had projected even in the February policy. So if we go back there, we knew that RBI is undershooting and there will have to be some action sooner rather than later. So that is one thing to remember. And then, of course, the Russia-Ukraine problem has just magnified the inflationary issues since then, and everything has become haywire. Clearly, while we were on the higher side of RBI's expectation, even in February, that magnitude is much higher now. So average inflation, number one, is from the January onwards, I would say, it's continuously above 6%, which is clearly what RBI does not want. They are answerable to the parliament after 3 consecutive quarters of above 6% inflation, which will happen by the September quarter. So they will have to write. Of course, I mean, it is something which why and how they plan to correct it, etc. So those answers will have to be given. So that is probably the reason why in April, okay, so the surprising part was why they didn't act in April. That is one thing which everyone was questioning, because by then the Russia-Ukraine problem had started. Questions were on where the crude oil prices are going to settle. commodity prices were on a roll. So it was already becoming challenging and expectations were building up for a much more hawkish RBI in April. But somehow they refrained at that point. And they, of course, did try to normalize the policy corridor to an extent. So that was the first step that they took. And then comes the off-policy cycle rate hike. If you just look at the April till now, the effective policy rate hike, that is around 90 basis or so. And why I would say that is because we know that our, because of the surplus liquidity that has been there since the pandemic, our effective operating rate, the overnight rates have been closer to the reverse repo or even below the reverse repo then. Now we have to talk about the Sdf rate. So now it's overnight rates are a little below Sdf rates, but because from a 335, we've moved to 4.15, that lower end of the corridor. That's the reason we've seen that. If we look at the MIBOR rates, the overnight interbank rate, basically, that itself has moved by 88 to 90 basis. So I would say the effective tightness that has happened in the last 2 months by RBI. So they've tried to play catch up. That's what I'm trying to arrive at from wherever they were dealing initially. So that is one part. Now, going ahead, one is, of course, RBI's inflation expectations in April. They had provided their projections at 5.7%. That further needs to be revised up for sure. So that is probably going to be somewhere higher by 70 to 80 basis now in the upcoming policy. That's what we are expecting. We are at 6.4% average for the year, but that's only comforting towards the last quarter, I would say, where we can expect an average in the last quarter to be below 6%. Otherwise, till December, or rather, I would say till January, things are not looking anywhere comfortable in terms of inflation. So, number one, clearly the need for front-loaded action cannot be denied. But at the same time, we all know that these are supply-led issues which are resurfacing again and again. So at some point, we know that there is a limit to which RBI can manage the inflationary expectations through that. And hence the need for fiscal measures becomes much more important, which correctly so the government has taken lately. If we see the excise duty cuts, the custom duty cuts, the caps that have been there on exports, etc. So those are the measures which will probably cap the supply side inflation much more than what RBI can do. So to that extent, we are not looking at a very high terminal rate, but the need for continuous rate actions are there at least through this year because inflation is going to be very elevated. So to that extent, we are looking at this year exit at around 5.5 to 5.75 by the time we end this financial year. In this coming policy, 35 to 40 basis is the rate hike that we're looking at. Now, in this context, policy, like I think Dr. Virmani said, we have to look at 2-3 aspects here. One is the repo rate hike. The other is the liquidity stance. And of course, the overall policy stance that, that we've already seen. Actually, the withdrawal of accommodation has already been conveyed and communicated by RBI. So I think that I don't expect that to change at this point. At this juncture, I don't expect it to change. It will probably change towards the end of the year or so. And the reason is because the RBI has somewhere communicated that they are kind of in accommodative phase still. Liquidity is ample and also till their real policy rate remains negative. So to that extent, I think that the stance will not become neutral right away. It will probably be where it is at this juncture, withdrawal of accommodation. Secondly, in terms of real policy rate, it is only, like I said, because I'm expecting inflation to go at sub 6% only towards the end of the year. That's where I expect the real policy rate to become marginally positive. And that's where I think they will get a breather to stop at least and watch as to how the impact of rate hikes and all have been. So till the December back-to-back rate hikes should happen. In February, it's not yet certain, but I would say they could continue through February and then probably wait in April or pause in February and then again go ahead in April if needed. So overall, I think 5.5 to 5.75, at least for this year, looks reasonable to me. Beyond that, also, I don't expect too many rate hikes, but another 50 basis of rate hike into FY24. That's where probably the terminal rate could be. That would also put in the positive real rate back in the picture to an extent which is absolutely necessary for financial stability to an extent. So that would be also important. On the liquidity side, just want to highlight that in the off policy, the bigger surprise to markets was, I would say, is a CRR hike, because even without a CRR hike, the natural drainage of liquidity was expected to, be. We were expecting that liquidity is going to be drained out naturally through the course of the year, and because RBI had initially conveyed that they are going to take 2-3 years, at least 2 years, let's put it like that, to normalize liquidity, there was no expectation of a rate hike, a CRR hike. But they've gone ahead because of front-loaded need for action. And hence, I do see a chance of a CRR hike, another one, because largely they want liquidity to remain in non-inflationary zone, which is going to be 2 to 2.5 lakh crore largely. And for that to be there, I think CRR hike will happen, but not in the June policy. I assign a higher probability in the August policy. Also, because when we look at liquidity, we need to look at durable liquidity, not just the net LAF number which comes out. And that is still 6.5 lakh crore or so. So that number, once government starts spending, actually they're not spending right now as much, so the cash balances are high. Once they start spending, this liquidity will be back. And that's when probably again the need for CRR hike will be there. But that's why I'm not saying for a June hike. I think they can wait right now and probably go for a hike in August. But at some point, they need to withdraw liquidity fast, because only when that happens is when they'll be able to manage this entire non-inflationary environment. Just one thing in terms of data, RBI's inflation expectations, if we look at 3-month and 12-month ahead, it's actually not yet become very alarming. I mean, we have seen a 7-8 basis up move in the most recent surveys, but it's not very alarming yet. So that is, I would say, very surprising. Given all that is happening around, we're still not seeing, I would say, a de-anchoring of inflation expectations. Despite palm prices being higher, despite all of food prices being higher, we're yet not seeing that. So we'll have to remain watchful on that front as well as to how that really evolves going ahead. I think government's measures will be very crucial in anchoring inflation expectations. RBI can only assist on as a secondary line, not on the primary side. That's I would say. So yeah, that's it from my end.
Thank you. Yeah, I just want to mention one aspect, just a small thing which I forgot, and then I'll turn to Abhik Barua, who has come back to us after some time. I guess he's been busy. So the point here is, kind of I myself have not mentioned, others don't mention, but the real rate is important because it also affects capital flows. So in my suggestion, that is implied because the real rate in the US has clearly risen relative to the Indian one. And that is partly, I haven't done a full analysis, but if others can add to that, if they've done it, that is part of the reason which is drawing the FII outflows from driving several quarters out of India. So somebody may want to just touch on that. So with that, let me first call Abhik and welcome back. Yeah.
Sorry, am I audible? Okay, right. I'm sort of very much on the same page as both Dr. Virmani and Upasana in many senses. One is the fact that I think in anchoring inflation expectations, which are the principal problem, and I think Dr. Virmani highlighted a very important fact that a one-off repricing of a particular critical commodity like oil does not sort of build on the dynamics of inflation. It's just almost like an accounting issue. but it sort of certainly adds to inflation expectations, and you have food prices, etc., along with that. So I would think that yes, supply. The persistence of inflation, headline inflation, does not necessarily make what is intrinsically still a supply side problem, a demand driven one. I think the US's inflation dynamics are very different. And it starts with what Dr. Virmani referred to, the huge fiscal push, which continued even when the economy has started recovering. So the US is in sort of a textbook inflationary environment where there's an increase in wages, which is feeding through to prices, and then feeding back to wages again. I think we are in a very different scenario from that. Um, Having said that, I think while I would tend to go with Upasana that, I mean, perhaps the heavy lifting would have to be done on the supply side. The RBI does have a role to play, and since even the effect on inflation expectations are felt with a lag, it's best to front load things. I think specifically in the June policy, just to differentiate ourselves from the West, which, as I said, has a very different inflation dynamic. Perhaps we shouldn't sort of go the whole hog and do a 50 basis point hike and a CRR increase. Perhaps we should, as a part of the signaling process, and to prevent disruption in the system where there hasn't been that much fiscal support, I think we perhaps need to do maybe a 25 basis point hike, and I think change the stance. I mean, I'm really very confused as to what moving to focusing to accommodation means. I mean, just go to neutral and just change the stance. That itself has a powerful signaling effect. I would go with a 25 basis point hike with a clear sort of communication that more are likely to come. And I think the terminal rate for this year, for our bank's research exercise, is around 5.4 to 5.75%, and maybe one or two more rate hikes in the next fiscal year. That's broadly what I wanted to say. But one thing that I just like to just quickly focus on, and I think the MPC and we as a sort of shadow MPC might want to sort of ponder over, because it has to do with what is happening around the world. So what kind of assumptions can we make, or what kind of calls can we take on the global economy going forward? Clearly, there is a global slowdown coming. And in terms of the drivers of the slowdown, it is the slowdown which is being engineered in the US and China, which is in the middle of the throes of a long-term structural slowdown, which got exacerbated by their inscrutable COVID policy. But even if they show a bit of a blip once they sort of remove, let people out of their apartments in Shanghai, the slowdown will continue. And I think the median forecast is less than 4%. So there's a global slowdown. So what can we assume about certain critical prices when we think about inflation, particularly commodity prices? I would think that commodity prices are likely to come down. And what we are seeing today, and I think this is interesting, and I know all of you in business would know this, that there is a clear sort of disconnect between energy prices and non-energy prices. Non-energy prices have been coming down. I mean, there have been little spurts in between, following the China news, but they've been on a downward trajectory. So to take copper, aluminum, a bunch of other things, steel, they are reflecting the possibility of a decline in demand. The second and perhaps the last, the second last thing that I sort of wanted to talk about is the fact that what does China's opening up do? So China, you must realize, is both a provider of demand, and hence when China recently unlocked Shanghai, things like oil prices, etc., and some non-oil commodity prices went up. So it is a provider of demand for a large bunch of items, particularly commodities. It is also, don't forget, it's the mother factory of the world. So if China kind of operates at a low rate, it creates supply problems across industries and units. So I think we'll have to think of the net effect of China kind of uh, shakily getting back on track and sticking to the 4% growth rate and not dropping significantly further. Would the predominant effect be demand, which is going to shore up prices again and add to global inflation pressures? Or would it be an improvement in the supply situation? I would go with, the net effect would be an improvement in the supply, particularly of a wide range of industrial intermediates and consumer goods that China produces. So I would think that China's kind of the steadying of the Chinese economy would be positive in the sense that it would bring global inflation down. I tend to sort of, real interest rates are indeed a factor when it comes to looking at capital flows, and that's what happens. But I'm, while the sort of the numbers and the relationships are established for debt flows, I'm not too sure what the equity side looks like. And one of the things that we shouldn't take for granted is that even if and I'm talking about capital flows, and we've seen the decimation in the markets led largely by the foreign institutional investors, the so-called FPIs now. But I think one block within Asia is emerging as a very attractive block, which is, the ASEAN story is getting more and more traction. I read, articles in Bloomberg which with headlines like, "Is Indonesia the next China?" Malaysia is going to be a high growth economy, a high income economy technically in a couple of years. There's a lot of confidence in Thailand in terms of with the tourism sector opening up, and they do have a very solid manufacturing base. These are countries unlike the North Asian countries like Taiwan and South Korea, which are not that dependent on China. So the bottom line is that we have competition, and I think that the need for consistent signals in terms of whatever policies we commit to, I think that becomes that much greater in attracting capital back as our real interest rates for a certain asset class. So I would say, just to end, 25 basis point hike, change stance to neutral, do not increase CRR right away. I would go with Upasana's, do it tactically. I would go with Upasana's view that August is perhaps a good time to do it. And yes, signal that you are raising rates, but don't give the markets or industry the impression that you are doing another Fed, because our underlying conditions are nothing like what the US is seeing. So I'm going to end here.
Thank you. Thank you. Yeah, so that's good that you raise these issues. I'll just briefly kind of highlight them. Of course, we'll have more discussion on monetary policy. So firstly, I think commodity prices, that is absolutely spot on, which is that from our perspective, oil is clearly very, very different from commodities. And I think the oil prices is really going to be influenced by sanctions and the Russia-Ukraine war, which, as I highlighted last time, is likely to, some form of sanctions is likely to continue for, the war may continue for at least 6 to 9 months, and some form of sanctions for much longer. So the oil prices really have to be thought of, particularly for us. It's not just energy, it's oil, which is really, of course, coal and others get affected with it. I would agree. My guess would be the same, that the other commodity prices will probably soften, but oil won't. I wanted to just emphasize that. The second very interesting point, I think you framed it very well. That's why I want to highlight it, kind of what had gone out of one's mind, but you have very rightly brought in that, of course, one got a little carried by that, because the uh, export supply chains actually are functioning better than the domestic, but still, I think you're right, quite right, that there's bound to have been some effect of, various huge cities like Beijing and Shanghai shutting down. So clearly, even the supply chains for international orders and globally are bound to get smoother once we are over this. So that's a very good point, which we should remember. On net effect, I would also tend to go with you. I think uh, the net effect may actually be driven by the supply chain improvements. Though, as I said, there's a caution there, because that, from various stories one has read, that they kind of exempt, though they don't publicize it outside, they exempt the export supply chains from the restrictions. You see these restrictions that people can't move out, etc. That does not apply to transport of export orders, etc. So that's something we don't know very precisely, but because of that, the improvement may not be as big as one might expect, which you rightly pointed out, though, and therefore maybe come out more balanced, maybe neutral on the demand and supply effects. The third point, again, I think very, very interesting. I hope other people will bring out these points, because I think part of our discussion is to bring up these new issues. This equity investment, obviously, I mean, that you rightly point out that when we are talking about interest, real interest parity or something, we are really talking about debt. And therefore, it's very useful that you brought out these new developments, which we clearly should watch. If part of the equity investment is moving to these countries. I mean, everybody talks about Vietnam, but what you're saying is that maybe we should start watching the competition from Indonesia and Thailand. And Malaysia, of course, has always been there for what they call, slightly higher tech or middle tech competition with India. But yeah, Indonesia, I think it's an interesting point that we need to watch, and maybe even Thailand. Thailand, again, in some sense, is very much more closely connected to the Japanese investment in the auto sector, etc. So again, that's somewhat in our horizon. But Indonesia, really, I think you're very right to highlight that. Okay, so with that, let me call on. I think we are missing Indranil and Siddharth. So first Arjun, and then perhaps I think Mr. Raman or somebody is going to substitute. Yeah, Arjun.
Can you hear me now?
Yeah, where is
Arjun? Arjun Nagarajan.
Arjun Nagaraj? Here we are. Yeah, now I can see you there. Okay.
You can hear me.
Yeah.
Thank you.
Okay.
Hey, thanks a lot, Mr. Veermani. Just a couple of things. I think in our last meeting, I was expecting no rate hike from the RBI. So it came as quite a shock for me, given that the narrative from Mr. Das has always been in line with what Powell's also has been. So I still feel we still need a pro-growth sort of a stance. Maybe a front loading, maybe a 40 basis points rate hike in in this month's policy, and then possibly a pause until they really get a good grip on the data as to what things are on the ground. Because for the lack of a better word, I feel there's too much of this emphasis on inflation expectations at a time when there's really nothing you can do to control on the commodity side, which is largely reflecting in the WPI. But if you look at the CPI, it is the transport and communication bit that gets reflected, and that's something that very clearly is not in the purview of the RBI. It's something that government is trying to make an effort to sort of ease the supply pressures there. The largest chunk is wages, rural wages, and veggies continue to sort of really dominate. Food largely continues to sort of dominate. Cereal inflation has picked up, but it's not a very significant narrative as yet. So it's still veggies there. So I just feel that maybe this inflation expectations narrative probably is a bit overdone. The reason I still I'm having a fair bit of a bias on the growth angle is that, so we talk about the 7% sort of a number on GDP for FY23, but that's mainly on account of the fact that there's actually a fair bit of a high base there. So your underlying growth is in and around somewhere around 5.5%. So if you, I still am finding it hard to wrap my head around the market narrative of incrementally 100 to 150 basis points at a time when your actual underlying growth is only around 5.5%. So inflation in itself is cooling demand. You wouldn't want to increase or catalyze the impact of that on demand at a time when India is just picking up, when things are just getting better. Because if your demand really does come down, it affects your fiscal, because the government is not really looking at any incremental borrowing, because they are really very optimistic on the tax collections being fairly strong. They're expecting a fair bit of a pickup there, which is broadly what is sort of holding these numbers there. So I think elevated inflation in itself should do the job, and I think there's a fair bit of an overemphasis, personally I feel, on the inflation expectations angle at a time when from a CPI point of view as well, we don't have the inflation problem as the West, like Mr. Baru was talking about. We also don't really have an inflation problem as such. We have more of an inflation mandate issue. So it is trying to actually stick to the mandate that the problem is all about. That was one. Lastly, I think the focus will probably, rather should probably be more on the rupee, where the depreciation in the rupee has been a live risk from around October of last year. And it with 23 billion on the trade deficit recently, I think it's only ECB flows and your net FDI flows that are sort of holding it up. And we've seen in the last cycle that when rates globally start going up, especially in the US, your ECB flows also start coming off, which means it is much of a more increased risk, and even from a CPI and a WPI point of view. So I think some sort of toning down on the rates narrative after probably a 40 basis points rate hike in June. More focus on trying to address the rupee angle, because if you really want to push rates up, I think inflation in itself will cool demand. And when you start intervening in your currency with this 120, $130 billion you've amassed on the forex reserves, some sort of an intervention there in itself will actually start withdrawing liquidity, which will be pushing up your short-term rates as well. So I think there isn't much the RBI should do post probably a 40 basis points rate hike in this month's policy. Thank you.
But I need a clarification. I get your points, and it's good to have a counterpoint. But what is your expectation of, let's say, last quarter inflation? Because in some sense, what the Monetary Policy Committee does should actually be based on that, right? So when you say growth is weak, okay, I mean, we can discuss that, but what is do you differ with the other two on their projections, and why? If
No, so let me articulate this a little better. So I'm from the start, I've not really been very comfortable with the RBI's inflation mandate of 4 plus and minus being a stickler for this entire for this range. So my concern stems more from rather what the RBI should do, and trying to project what the RBI will do. What the RBI will do is sticking to this range, But what they should do probably is ignore the range anyway. They're going to write this letter to the MOF. So so if they can sort of underpin this narrative of expectations, and if they're quite confident that the expectations are not really going to be as much of a concern as it is made out to be, then I think they can just do one front loading 40 basis or 50 basis points and then give a pause there, because a lot of it, if demand does come down, demand is the only thing they have to really cool down to bring down inflation, at least what is there in their control. If they really do that a bit too much, the fiscal will go for a toss.
Yeah. Okay. So yeah. So I should add here that we've had a number of talks at EGROW. A few of them were actual estimates that the mandate, in some sense, people have argued based on their models and estimates that it shouldn't really be 4% but 5%. So we have an MPC 4% plus minus 2% band, and there have been people who plausibly, I mean, I haven't done such studies myself, who argued that it actually should be 5% plus minus whatever. I mean, if you think of plus minus 1%, then 4 to 6%. In some sense, the RBI seemed to have, from outside, again, I don't have inside information except whatever little interactions we have with other people present. But that seemed to have been the thing, and it seems like the RBI was suddenly concerned that it was going to go over 6% for a certain amount of time, which is kind of what the message the market was getting from what Upasana and Beek are telling me, which is really what seemed to have, if I may call it, frightened them into quick action. But anyway, we can come back for further comments from our participants. Let me take Dr. Charan Singh first and then Mr. Ram.
Thank you very
Dr.
much.
Charan Singh?
Yeah, thank you very much. I would rather go with the discussion with Arjun today, because I myself think that 4 plus minus 2, the inflation target uh, in a young demographic country is probably too artificial and needs to have been thought through and should have been a little higher. So the as far as the inflation data is concerned, it's obvious where the increase is taking place. And we all know it is transitory, it is because of the oil and transport where the major hit has come. I must also mention that the Russia-Ukraine war, which is taking its toll of the world, it's going to be impacting prices of corn, of barley, wheat, and sunflower seeds. As far as India is concerned, it's going to be also impacting the fertilizers, nitrates, and phosphates. A bulk of them come from Russia and Ukraine, and therefore that's going to impact us. As far as fuel is concerned, you have mentioned, but then the coal also is a significant component of from these two countries. So therefore, if it is so obvious that the price rise is taking place because of the Russia-Ukraine and this is transitory, I really do not see any reason why there should have been. Of course, it has already happened, so there's no point with hindsight. But why should there have been a knee-jerk reaction of 40 basis point, which was almost like a sledgehammer on an economy which has already started recovering? If we look at the data which has been released in May, look at the IIP data or look at the core industries, there's been a beautiful recovery. And if you look at the components of the recovery, and I was looking at it, the manufacturing of textiles, apparel, then paper and paper products, furniture, offices are opening back, people are coming back to normal life, and that's what is reflecting. Now, when you use a sledgehammer like this, obviously it is going to impact demand and it's going to impact growth. Now, I must also mention that the interest rates, I agree, across the world have increased, but look at the way it is increased in England and in Australia, 25 basis points. I don't deny that in the US it is 50 basis points, which is quite high. They've been talking about it of raising it further to nearly 1.75 by the end. But then, and of course, countries like Brazil, which raised it by 100 basis points. But in a country like India, I think when the recovery is starting and doing so well, using, having done it, the 40 basis point, using the interest rate cycle which impacts a huge number of industries, can really impact growth very badly. Now, knowing that there's a global slowdown expected in 2023, going by the data released by the IMF, there's a slowdown in growth. Our exports are certainly going to face a challenge there itself. So therefore, I would rather go with the judgment that need to change the stance from accommodative to neutral. It conveys a lot. And then the hike has to be a little more moderated. Why not 15 to 25 basis points so that the message is clear, but the economy is not impacted? Now I must bring in two more points. There's yesterday from IIM Ahmedabad, there was a release of expectations survey, and it shows that after the May 4 hike in the interest rate, the expectation of inflation fell from 6.12 to 6.02. So immediately the expectations reflected RBI's sledgehammer, but not significantly. So the point that if it's a supply side story, then how much can the interest rates do for holding on to expectations? So that has to be taken carefully. Now, the issue that Mr. Chairman you raised is a very pertinent issue on credit growth. And I must mention that the Reserve Bank has just released a report on credit growth, and credit to agriculture and allied activities grew by about 9.9% in March 22, which is still less than 10.5% in March 21. So credit growth in agriculture allied activities
Sorry, which is still less than March what?
2021.
Okay.
Now, when you look at the bank credit being given to medium industries, there is a significant improvement there. And that's why I'm saying interest rates need to be very carefully watched. It registered a growth of 71.4% in March 22 against 34.5% a year ago. Credit to micro and small industries posted a faster growth rate of 21.5% in March 22 from 3.9% year ago. So significant jump up there also. Now, if you look at the MSMEs in general, there's been a significant jump in credit. But if you look at credit growth to large industry, which was mainly in contraction till December 2021, it turned positive in January 22 and stood at 0.9% in March 22. So credit growth to industry has picked up in the recent past. And now if we raise our interest rates and it impacts, that is something really to worry about. Now I must also mention that in the recovery which has taken place in the month of recent times, core industries and IIP, construction has played a very important role. Steel and cement are doing very well. Now, suddenly there is an impact on the interest rates and construction activity gets impacted. It impacts the whole economy, including employment in the country. So therefore, my suggestion is that, well, while we need to moderate expectations, in view of the green shoots which are appearing, there's no harm in taking a back step now and raising the rate of interest by 25 basis point at the most or even less, and moving the stance which would impact the expectations from accommodative to neutral. The last point that I want to make, Mr. Chairman, is that the non-performing assets are expected to increase in the period ahead. The industry is obvious, and as I was mentioning last time too, the number of cases which are waiting to enter into NCLT are rising, and the fear that once normalization takes place, the recognition of stressed assets and non-performing assets could increase. So therefore, it would be better that baby steps are taken on interest rates, because in case this turns out to be totally transitory, the inflation, then the corrective measures can be put in place rather fast. And last point is, I think the CRR instrument should not be used At this point of time, it's better, if ever, to retain it for later purposes or not invoke CRR as an active monetary policy tool when recovery is taking place and bank credit is expanding. Thank you very much.
Thank you. The NPS, do you have I have a question. I've not been following too closely. Where is the danger? Where is the
You mean the places where the stressed assets?
because you said it's an expectation that it may happen. Did you have an idea of where the
Yes, the fear is that in the MSME sector, the recovery could get impacted. That is one place where the fear is looming large. However, the stress test which had been done by the RBI and reported in their financial stability report in December had also projected that in the worst case scenario, if the growth suffers, the stressed assets in the banking industry per se would increase.
Okay, thanks. Yeah, so yeah, I think in a way you indirectly highlighted a point which kind of needs to be taken. That is that we know that corporate industry is actually doing very well and has a lot of cash. So it actually is not borrowing. But it would be useful for me, again, as I said, I've not been looking recently, but to have for some of these non-corporate to compare the credit as of March with, like, say, 2 years and 3 years ago would be useful, because in some ways what you're kind of saying is a follow-up to what I was saying, that we would have to watch the credit growth, but you also have to watch it in segments which could go into NPA. So that's kind of what I want to alert, but I don't have enough information to make a more detailed point. So I think before we ask everybody who wants to add new things, let's have Mr. I guess it was Mr. Ram. I don't have it on my calendar. Who is it?
Mr. Raman Agarwal.
Raman, sorry. Yeah, Raman Mr. Raman.
Expert on NBFCs.
Right. Mr. Raman.
Thank you,
Yeah,
sir.
here you are. Sorry. Yeah, I can see.
Thank you, sir. While I'm certainly no economist, just a practitioner in the NBFC sector, picking up cue from what just Dr. Charan Singh said, I would further carry this forward from our experience in the NBFC sector per se. So just as we have witnessing also a increase in the vehicle sales as the latest data released by SIAM. So I'm talking of sectors which are direct customers of NBFCs. So, vehicle financing is one forte of NBFCs. So we are seeing increase in vehicle sales. We are seeing increase in the equipment sales, which is obviously a fallout of the government's stress on infrastructure development. And of course, going by the GST data, it clearly also reflects on the growth in the MSME sector, which again is a large borrower segment for NBFCs. So once again, echoing the point that, while I understand due to inflationary pressures, the need to increase interest rates, but we need to be cautious, just that it may not dampen the spirits or I would say the kind of required animal spirits which are just trying to show green shoots in the economy. So I think that is a word of caution from a practitioner in the NBFC sector, because more so that would directly impact their business. Now I'll straight come to a very important point, and sir, this will also relate to the point which Dr. Charan Singh raised, and you asked him a query also. Where exactly do you feel the NPAs are going to rise? I'll touch upon that point. There is also, apart from the actual change in the scenario of the business scenario, the change will come by a regulatory change. Now, I think I had highlighted earlier, there was a circular issued by RBI on 12th of November. Now, while it was addressed to all the regulating entities, but it is going to change scenario for the NBFCs per se. There are two strict provisions on that. One is on the stressed asset classification of what we do, SMA 0, SMA 1, SMA 2, and then NPA. That 90-day norm. Generally, NBFCs tended to be a bit flexible, considering, let me stress here, the borrower's need. Not because of our requirement, because of the borrower's needs, tend to be flexible and strictly not follow a day-end kind of a classification, because the borrowers we cater to have the flexibility in cash flows, and many of them receive their funds at the month ends. Many of them, because they are either SMEs working for the larger contractors or working for government or wherever. So the generally repayments, our experiences come at month ends. So we tend to follow a month end kind of a system for such classification. So for example, if the NPA, the 90th day comes on 21st or 22nd, so instead of strictly doing it on 22nd, maybe a leeway of another week taking up by the month end is what was being practiced. But this has been strictly put to an end by RBI now. It says now you have to strictly, by the day end accounting, before you close your accounting, you have to classify into an NPA or an SMA category. That's number one. But the second provision is what is going to hit us the more, which is that in order to upgrade an account back from an NPA to standard, till now NBFCs were following a practice, and it was also allowed that even partial repayment we could upgrade. So for example, if there was a total overdue amount of rupees 100, which includes some element of principal, interest and some penal interest, even if the borrower paid us say 70 rupees or 80 rupees out of 100, we were upgrading that account back to standard. But this now RBI has put up a stop. It says, just as a practice for banks, you guys also now need to ensure that unless the entire repayment is made in 100%, you cannot upgrade that account. Now, this provision is going to be a major, because in the current circumstances, to expect MSMEs and the small borrowers, again, I'm stressing upon, who are just coming out of that COVID pandemic era, to expect them to make 100% repayment is not going to happen. So what these provisions will do effectively is, one, the NPA tag will come strictly at the end of the 90-day, and it is going to last longer, because to expect them to repay 100% will ensure that the NPA tags gets elongated, which would ultimately make them kind of an untouchable in the credit market. So, and that will also result in the increase of NPA levels to an extent. So I think this is something, because the focus here, and I think just few days back I wrote an article also on this, that perhaps the entire paradigm shift in formulating regulations for lending, there has to be a borrower element in it. Just as the world over is focusing on the ultimate user, human behavior, all IT developments are focused as the ultimate user. So similarly, all lending regulations have also to keep in mind the ultimate borrower. So to have similar prudential norms for a 50,000 rupee loan given to a small borrower versus a 500 crore rupee loan given to a corporate, to have same prudential treatment, I think is perhaps needs a relook. And while I agree that there is a need to be aligned with the global practices, but we have a very vibrant, robust non-banking lending sector in India. Balance sheet size runs over 35 lakh crores now. So I think which has survived and grown because of that element of flexibility in our system, considering again the borrower's needs. So I think this needs to be have a relook. And this circular, while earlier was supposed to be effective from 12th November, post our representation, RBI had deferred it to 1st October, because that is where the new scale-based regulatory framework will kick in for NBFCs. But our request has been that perhaps there is a very serious case here to relook, and our suggestion is that all loans up to 2 crores ticket size should be exempted from these provisions. And the bigger loans may be subject to such kind of rigid NPA provisions or the prudential norms. So I think that is a very, very important point. Finally, I have two quick short points to make. In September 2021, there was a very welcome circular issued by RBI, because now my focus is obviously, sir, on the statement of regulatory and development policies, which RBI comes up in the part of the monetary policy announcements. RBI had issued a circular in September 21 inviting applications from NBFCs for acting, getting licenses as KUA or sub KUA for Aadhaar authentication. This was a very welcome step. Many NBFCs have applied. Surprisingly, till now, only 30 odd applications have been processed, and finally they have been issued licenses. There are many applications pending, and the even more surprising element is that there has been absolutely no feedback or response coming in from RBI as to where is the delay. I mean, we are receiving complaints from our members, and some of the very, very well-run large NBFCs are also facing this issue. There is absolutely no response. I mean, it's been more than a year now, almost, sorry, not more than a year, but 7 to 8 months now, and there has been probably no progress. I think that needs to be expedited, because this is a very good move done by RBI, but unfortunately, it's getting delayed. Finally, sir, there is just to keep at that, we all know that RBI had set up an expert committee on digital lending, because it became a area of concern. We saw a lot of malpractices creeping in, because a lot of unwanted players and a lot of dirty money coming in from all sorts of places. The committee has already submitted its report, and the sector and even, I mean, everybody as a society, but we more so at the NBFC sector, are eagerly awaiting the digital lending regulations. I think that is something which we need to have maybe a wider dialogue also, because that will also have an impact on the NBFC sector, because a lot of digital lending players are registered as NBFCs with RBI. So those are my key concerns.
Thank you. Very briefly, if our other discussants want to say anything on any of the issues, Upasana, Avik, and then Charan, if you want. Or Charan, you have something, go ahead, then they can think.
Yeah, I wanted to supplement when I spoke about the stress test and the NPs rising. The point you raised is where all. So it is basically in infrastructure, textiles, and metal manufacturing, where according to the RBI, the stress levels could be high. As you know, with the public sector banks playing an important role in these areas, the stressed assets for public sector banks are projected to rise further. And when they rise, of course, then the capital adequacy ratios kick in, and they need to be accommodated from the union budget. Thank you.
Okay, anybody else want to add anything? Because we've passed our 1 hour, but if somebody has a quick point or a question. Yeah, Mr. Anand, quick question. RK Anand. I can't hear you, Mr. Anand. Mr. Anand raised his hand, but I can't hear him. Charan?
Just let me see if he has asked a question in the chat box. Otherwise, Mr. Anand, can you please ask your question? In the chat box, I don't see anything.
Okay. Yeah, the hand came up, but it's gone. Okay. So thank you to all the discussants. And with that, let me hand it over to Charan to conclude.
Yeah, so I must thank ASSOCHAM for giving us this opportunity to coordinate with them for the shadow monetary policy. The vote of thanks, I think, is coming from the ASSOCHAM, so I'll wait for them to please. Is Mr. Deepak Agrawal, or who's giving us the vote of thanks?
So, Mr. Vasudev Mukherjee.
Vasudev, yes.
Dr. Virmani, Mr. Agarwal, Dr. Charan Singh, Mr. Indranil Sengupta, Ms. Upasana Bhardwaj, distinguished ladies and gentlemen. This has been a very stimulating conversation, and we from ASSOCHAM are, been taking copious notes, and we're going to be compiling this and representing some of this to the RBI shortly, just in advance of the monetary policy. And I'd like to thank everyone for joining us today. And we've of course overshot our time, but just wanted to mention that ASSOCHAM is organizing a few major activities, which I thought I'd just mention here. The first is the National Summit on Trade Finance in the month of July, the 17th Annual Summit and Awards on Banking and Financial Sector Lending Companies in the month of August, and the 14th Global Insurance Summit and Awards in the month of September, and many more. Dr. Rajesh Singh, who's online with us today, you can reach out to him, and he will help you with the information on all of these. So once again, thank you for joining us, and we look forward to having you with us again. Thank you.
Okay. That concludes the session, I guess.
Yes.
Thank you, everyone.